Rally for Time is here, and you're clicked in and logged on Armourgate Radio Communications. Our theme this quarter is corporate financial strategy and sustainable growth. Corporate financial strategy and sustainable growth. Abiodun Abari, and I'm privileged to host you this Wednesday. You're most welcome. Finance, being the lifeblood of any organization, has made corporate financial strategy the cornerstone of overall corporate strategy. Okay, recall that I said that corporate financial strategy must not be in isolation from overall corporate strategy. It must be consistent. Okay, and it is most desirable that corporate financial strategy leads to the ascertaining of the going concern credentials of the organization. Okay, so it's important that corporate financial strategy as a means can lead the organization to sustainable growth as a desirable end. And sustainable growth being the maximum growth rate an organization can achieve without resorting to additional financial leverage. Okay, that the maximum growth rate an organization can achieve without resorting to additional financial leverage. And please do not forget that at Armourgate we help our clients with sufficient framework to achieve optimal corporate financial strategy. Okay, and when we talk about an optimal corporate financial strategy, we talk about a corporate financial strategy that will ensure sustainable growth for the organization. Okay, corporate financial strategy that ensures sustainable growth for the organization. The corporate financial strategy consistent with the overall corporate strategy of the organization, not something chaotic, not something that's inconsistent, not something that provides the required balance, right? The required push towards the achievements of overall corporate strategy of the organization. Okay, so we talk about a corporate financial strategy that galvanizes across departments, across units, and causes employees to coalesce behind consciously. Okay, coalesce consciously behind a clear, unambiguous, measurable, and reliable goals. Okay, a corporate financial strategy that galvanizes across departments, across units, and causes employees to coalesce consciously behind clear, unambiguous, measurable, and reliable goals. Yes, a corporate financial strategy that will ensure that the CFO, the Chief Financial Officer, delivers. Okay, and that's actually under promises and over delivers. Okay, talking about prudence and talking about the CFO, we've been able to establish the key roles of the CFO. Okay, talking about in the development and implementation of the financial strategy of the organization. Okay, which we say that it should always align with the overall long-term objectives of the organization. Okay, and of course we've talked about the role of the CFO in providing overall strategic financial leadership cannot be overflogged. Okay, and of course ensuring that consistency, ensuring that integration, as I just said a while ago, very, very important. And of course in terms of financial performance and management. Okay, financial performance management, ensuring that there's adequate monitoring, okay, of financial performance, and of course relevant metrics, ensuring that periodic and regular reviews are conducted, and there is adequate reporting of financial performance, ensuring transparency and accountability in financial management, and identifying areas of improvement and offering solutions. So we have talked about how important for the CFO to be able to provide insights into market, insights into economic data, insights into risks, governance risks, where risks are coming from, even a regulatory environment. Okay, and so that the organization be able to prepare adequately and mitigate those risks, of course. And talking about ensuring that advice that is given to organization supports sustainable growth and financial stability. Very important. That role of providing overall strategic financial leadership for the organization. So that leadership must actually be agile, must be adaptable, must be robust. Okay, it must be holistic to ensure that the functions are well efficiently executed and in line, as basic requirements, with overall objectives, overall strategic goals of the organization. Okay, so as the CFO continues to supervise and play an oversight role over the financial system of the organization, it's important that the changes in the environment, in the business environment, in the task environment are well factored in necessitating the adaptability of the corporate financial strategy. Okay, so as to ensure that it's continuously relevant to achieving sustainable growth for the organization. And of course, the review as regards financial performance, how what has delivered, as the corporate financial strategy has delivered. Okay, I mean, it's true, always be as mirrored against the financial performance. Okay, and you look at how outcomes are well aligned with projections. So we continue to emphasize that the financial health review will actually give us a pointer to how well the corporate financial strategies are working and how much tinkering is needed, okay, and what are key areas. All right. So importantly, the chief financial officer has to understand that the deviations from projections should necessarily elicit tinkering with the corporate financial strategy. All right. So adaptations, might involve direction of funds among priorities, even reordering of priorities. Okay, and it might have the jettisoning of financial costs altogether. Okay, even modifications, budgets. All right, so the CFO must be willing, must be ready to adapt as and when due, as and when demanded, so that the corporate financial strategy, like I said, is continuously able to relevantly deliver the financial objectives of the organization in alignment with the overall objectives of the organization. And of course, we have to understand that in delivering that effective review, that to improve the corporate financial strategy, objectivity should actually be imbibed, should actually be a watchword. All right. So, and in that, you understand that even the insights and projections and submissions from analysts, from advisors, from renowned brands and benchmarks should also be inculcated to enhance the objectivity of the review. Okay, since the essence of the review and evaluating the corporate financial strategies to ensure that it is continuously able to relevantly deliver the financial objectives of the organization in alignment with the overall objectives of the organization. So we continue to delve into corporate financial strategy as we continue to dimension corporate financial strategy to deepen our understanding and ensure that our view is holistic enough to ensure sustainable growth as a desirable and achievable end. Okay. So we understand that corporate financial strategy itself is fundamental to achieving sustainable growth. Okay, so and when you're thinking sustainable growth, you're not thinking short term. When you're thinking something sustainable, naturally you're thinking beyond the short term. Alright, so and there has to be that balance of economic performance, of financial performance with environmental and social responsibility. Okay, like I said, corporate financial strategy should be holistic. Very, very important for it to be continuously relevant, for it to be effective. Okay, so it means that it's that provision of the framework. Okay, for managing financial resources. okay, must be able to ensure long-term stability, resilience, adequate resilience, and addition of value for all stakeholders. All right, different stakeholders. All right, so value addition for all stakeholders. All right, so like I said, we continue to dimension our corporate financial strategy. Okay. For achieving sustainable growth, and like I said, when you're thinking corporate financial sustainable growth, okay, and corporate financial strategy, we are talking about long-term financial planning and investment. All right, we're talking about sustainable growth. All right, so it means that when you now talk about aligning your corporate financial strategy to achieve sustainable growth, your capital allocation should be strategic enough to ensure that investment capital towards sustainable initiatives, R&D, products of the future, future-proof products, okay, future-proof products, innovative projects, okay, that will yield long-term returns, that will give the organization an edge, right, that will ensure that the organization is well ahead of competition. Okay, so there should be a strategic capital allocation towards creating that edge, because it's that edge that will ensure that the organization is profitable for a longer time. Okay, all right, so there should be strategic capital allocation. All right, that is when you are thinking about long-term financial planning and investment, okay, in the context of achieving sustainable growth through corporate financial strategy. All right, so in allocating capital strategically, right, so we are making sure that we are directing the investment capital to sustainable initiatives, to research and development initiatives, to initiatives that will ensure that future-proof products and services are churned out to ensure that the organization keeps that competitive edge for a long time and ensures revenues and profits for that long term. So it also means that the budgeting and forecasting too must be sufficiently effective. All right, so in doing that, you ensure that budgeting and forecasting tools, all right, should be able to anticipate future needs of the organization, be able to do optimal resource allocation, to project optimal resource allocation, all right, and also ensure that the organization is able to wade through market fluctuations without being flustered. All right, so the budgeting and forecasting tools too must be top notch. All right, to ensure that the long-term financial planning and investments dimension of achieving sustainable growth through corporate financial strategy is well achieved. All right, and of course we continue to talk about the optimal capital mix, optimization of the capital mix too. All right, so that balance between debt capital and equity capital. All right, so very, very important to determine the optimal capital structure, that will be able to fund the growth of the organization without incurring unnecessary financial risks, or without jeopardizing the long-term financial health of the organization. Okay, very, very, very important. Okay, that debt should not, the organization should not be over leveraged, okay, to the extent that it will not be able to meet its obligation as and when due, and meet its working capital requirements. Very, very, very important that look at the financial risk, okay, that which debt will be posed in that regard. That you have to understand that having the optimal capital mix, okay, is very, very important for the long-term financial planning and investments as regards that. Okay, so we also look at another dimension in terms of operational efficiency and of course optimizing cost efficiency. Okay, optimizing operational and cost efficiencies. We have to ensure that we sustainable practices are imbibed. Sustainable practices that will ensure that cost efficiencies are continuously improved, maintained, and improved. Right. So resources are ultimately reduced, and waste, fraud, and abuse are actually reduced to the barest minimum. Okay, in terms of energy consumption, the efficiency is ensured. Okay, there are strategies to ensure that energy efficiency is assured and continuously improved, and of course, we should ensure that there are strategies that will continue to track these efficiencies so that profit margins are impacted and capital are freed up to explore other strategic ventures. Okay, so evidently very, very important, okay, as you mentioned, right, that you look at operational and cost efficiencies. Okay, and in terms of that, look at the practices that need to be imbibed, the practices that need to be inculcated, okay, to ensure that cost efficiencies are continuously improved, and cost efficiencies are continuously improved, like I said, and the waste, fraud, and abuse are reduced to the barest minimum. Okay, and that will of course impact profit margins, all right, and free up capital for other strategic initiatives. And look at another dimension in terms of the risk management. All right, so there should be adequate proactive provision to curtail risk. Okay, so there should be the identification, the evaluation, and mitigation, of financial and non-financial risk as it concerns the organization. Okay, I'm talking about other risks that involve supply chain vulnerabilities. Okay, and those risks should actually be projected. Okay, the financial. The dimension of the corporate financial strategy should be able to adequately address that. All right, so that there won't be any room for the organization to be undermined in that regard. The risk management framework should be robust enough to ensure that the vulnerabilities, and of course we also look at regulatory changes that when they happen, the organization is able to adapt without incurring any loss of revenue, okay, or any unnecessary costs, okay, that would impact its margins. All right. So importantly, that we also look at the reporting and stakeholder engagement. All right, the reporting aspect too, very, very important, because you don't want any stakeholder, okay, undermining the organization, okay, in whatever form. You want to ensure that all stakeholders are on board, all stakeholders are key in. Okay, so you ensure that the reporting, the financial reporting, is transparent and very, very clear. All right, and of course, you also ensure that the sustainability performance of the organization too is put to the fore, so that not just investors and customers, but regulators and civil society and other stakeholders are able to key in into the organization's long-term plans and ensure the right support from all stakeholders. Okay, so and very, very important too that we also understand the importance of integrating ESG factors. All right, so environmental, social, and governance considerations too have to be inculcated into financial decisions. Okay, very, very important. So we have to understand that potential risk are associated with factors like climate change, or even like I said, the regulatory environment too. Okay, so in terms of environmental and social and governance factors, right, very, very important to ensure the achieving sustainable growth through an adequate and very effective corporate financial strategy, right? So in that regard, green technologies will be explored, all right? Even sustainable products, okay, and also talk about looking at the way green financing too. Very, very important, inculcating all these environmental, social, and governance considerations into all financial decisions, right from capital allocation down to risks management. Very, very important. Okay, so helping to identify and mitigating these potential risks. Okay, help achieve sustainable growth through an effective corporate financial strategy. Okay, so of course I talked about leveraging green financing. Yes, we're using financial instruments, right, like such as green bonds and sustainability linked loans, right, and of course there are government subsidies that actually that finance transition from a carbon heavy organization to a greener and more sustainable business model. Okay, so we understand that corporate financial strategy should act as that driver of sustainable growth, right? So the corporate financial strategy should be able to take the organization towards sustainable growth. We help the organization achieve sustainable growth. Okay, so that balance of profitability with social and environmental objectives, okay, ensuring that all stakeholders actually are carried along, as it were, okay, in achieving sustainable growth. Okay, so when you embed sustainable objectives, when you ensure that sustainability factors are considered in the core financial decisions, in the real financial functions, right? So it helps the company build resilience, all right, and of course the reputation of the brand is enhanced, all right, because the companies will be able to weather the storm, all right, whatever storm that comes maybe from the regulatory environment or even from the society and from the public, so it helps ensure the long-term success, okay, as the global economy continues to evolve. Yeah, so let's continue to break these strategies down to really see what they involve and how we can really framework an adequate corporate financial strategy that can help achieve sustainable growth for the organization. Okay, so when we talk about the long-term financial planning, the strategic financial planning, strategic long-term financial planning, right? So of course, the market analysis is very, very important to analyze market trends and conditions and be able to forecast future financial needs of the organization. It must be holistic and setting the goals too. Okay, that's talk about apart from financial goal setting, which involves the setting of clear and ambiguous, realistic, and of course measurable goals that align with the overall business objectives. Right? So we also ensure that resource allocation is very, very effective in strategic financial planning. All right, so and there should be contingency plans developed, right, so that potential risks and uncertainties can be adequately addressed. Okay, and when we look at efficient allocation of capital, okay, when we look at, we want to see how the ROI of projects compare assess the potential returns on investment, to us to know how to direct resources to optimize what we have. All right, so when you have an evaluation, of course, you'll be able to prioritize. All right, and when you prioritize, then you'll be able to allocate capital optimally. All right, optimal and efficient allocation of capital, and that process should also always be subject to continuous review. Okay, so because you look at performance, right? Look at conditions, look at changes in the environment, changes in the market, in the business environment, in the task environment, and so on. And so, regular reviews, you also want to ensure that your capital allocation model is continuously able to deliver on the objectives. All right, so, and of course, talking about the optimization of cost efficiencies, optimization of cost efficiencies, and look at how we can do that in trying to implement cost controls. All right, so the use of cost control measures to manage and reduce expenses. All right, that's regular audit of costs. Okay, so that's that regular review of cost, that regular audit of costs, be able to identify areas where costs can be reduced, areas where savings can be made. All right, so we want to ensure that waste, fraud, and abuse are reduced to the barest minimum. So the regular conduct of cost audits will help achieve this, expose those areas where there can be potential reduction. All right, and of course we want to be able to streamline processes. Okay, processes that align, combine them to remove inefficiencies. Okay, so costs can be actually lowered. Okay, so talking about optimization of cost efficiencies, very, very important. And of course you also want to ensure that the organization is able to adequately diversify its revenue streams to mitigate the risk. All right, so seek to expand our market, seek to get new markets, new geographies, new target population. All right, so talking about of course development of new products, innovative products. All right, investment in R&D that will turn out innovative products. All right, so we also want to look at even the formation of strategic partnerships. Okay, partnerships that sort of integrate processes, that integrate supply chains. All right, so and of course also talking about the investment in technology and innovation. Right, so that processes can be optimized. Right, so that investment in automation and optimization of processes. Right, so the employment of AI-powered processes. Okay, to help ensure that the company is very, very competitive. Okay, so of course, so that's it's important that resources are allocated to research and development, so that innovation can be actually well driven. Right, so digital technologies are well embraced, so that the overall customer or client experience can be optimized, and the operational effectiveness and efficiency continuously ensured. Okay, so at this time I will take a break, and when we come back we'll be concluding this episode. Please stay with me.
Armourgate, founded in 2008 out of a desire to build transgenerational structures for organizations, institutions, and nations. We have worked with large businesses, international development organizations, and public sector ministries and agencies. Armourgate, our uniqueness is that we do not just work for you, we work with you. For example, we do not leave you to the task after sourcing talent that will help the new hire settle into robust leadership development programs. We are technical experts in advising and supporting institutions on strategy and leadership, artificial intelligence, strategic human resource management, public sector reform, finance, audit and tax, FAT, and strategic communications. We do Do all this and more out of a desire to transform nations through institutions and organizations. For further inquiries, email contact@thearmourgate.org or call +234 810 999 6666 +234 807 957 4151 and +161 0504 6026. www.thearmourgate.org. Armourgate, building to endure and transforming nations through institutions and organizations.
Welcome back. It's still corporate financial strategy and sustainable growth on Armourgate Radio Communications, and I'm Abiodun Abari, your host. So we continue to look at how to implement these strategies, these corporate financial strategies that will help us help your organization achieve sustainable growth, how to actually implement them. So we're breaking them down now. Now we'll talk about the optimization of our working capital. Okay, so in optimizing working capital, very, very important that it's liquidity. The enhancement of liquidity is actually a very table objective. All right, so inventory levels, should be optimized to ensure that there is adequate liquidity for the organization. So processes needs to be streamlined, and to that, of course, look at accounts receivable, accounts payable processes should be streamlined to ensure better cash flow management. And when you look at the cash conversion cycle too, it's something that needs to be impacted, right, to ensure that there is adequate working capital, right. So the cash conversion cycle should be optimal so that the working capital can always be optimized. Very, very, very important. Okay, so and in robust risk management, in having that robust risk management framework, you understand that the key financial and operational risks, financial and non-financial risks, regulatory risks should be identified, all right? Environmental risks should be identified, all right? Financial and non-financial risks identified, all right? Operational risks are identified, and of course, our strategies should be formulated to ensure that those risks are well mitigated, all right? So then, of course, the CFO should be someone that has the ability to deliver that. So, but that process of continuously monitoring risks should be very, very important. Right, so that we want to be able to continuously assess the risk management framework and evaluate the potency and adjust risk management practices as demanded by the feedback. Okay, so you also look at how well the debt management is optimized. Okay, apart from having a very healthy debt to equity ratio, like I said, having a healthy an optimal capital mix. Okay, very, very important that debt capital good, well optimized when it's used to finance very high return on investment projects that have high ROI. Okay, so it's strategic to use debt financing for projects with high return on investment. Okay, so that will actually achieve optimal financing for the organization. So of course the debt structures should continuously reviewed to ensure that when the refinancing and rescheduling is adequate, is in line, is done as when due, as and when necessary. Okay. So apart from that, we also look at the strengthening of the corporate governance of the organization. Okay, corporate governance in terms of ensuring robust internal controls. Okay, ensuring that the financial integrity is assured. We recall the case that we discussed last episode, talking about Aaron, how Aaron did not ensure transparency in his financial dealings and was unethical, in his financial management, and that led to the failure of Aaron. Okay, and talking about ethical ethical practices, ethical business practices need to be upheld so that stakeholders will have adequate trust in the organization, and that will ensure that they give the required support, the necessary support for the success, continued success for the sustainable growth of the organization. Alright, so of course, government policies, the regulatory environment should continuously review to ensure that compliance is done and seen to be done. Okay, so and of course the environmental and social governance criteria factors should always be considered in investment decisions, always be considered when evaluating projects, always be considered in capital allocation, always considered in making decisions, ultimate decisions as regards capital or allocation. And of course, the organization should ensure that corporate and social responsibility initiatives are well carried out, adequately carried out, to enhance the reputation and brand of the organization. Alright, so at this point, we've come to the end of today's episode of corporate financial strategy and sustainable growth. Until I come up here on devices again, please do keep learning, keep impacting. Thank you, and God bless. Bye bye.